Good evening. It's November 11, Thursday, 6:53 p.m. Welcome to episode 24, Meatflation. Good evening to you, Wawi.
Good evening, Mark.
And to our listeners, end of the day. It's end of the day Thursday, 7 p.m. This is your host, Mark Yu.
Wawi Santos.
And welcome to the Mark Yu and Wawi show. Disclosure: this show is made for sharing information purposes only and not to be considered investment advice. We record once a week, and while we are both physical therapists here in the USA with the same passion and same interest in researching and investing our hard earned money in the stock market. The show's goal is to share and learn from each other, answer questions. And to our co workers in the medical field, thank you guys for your hard work. We are available in YouTube, Spotify, and Google Podcasts. On our previous episode, 23rd episode, we discussed the Uber and Airbnb blowout earnings, the Peloton and Zillow's significant stock price drops, and what's the reason behind them. And we also discussed the tapering announcement that the Fed had made, and also the consumer sentiment that is declining. So we also played several clips, including Zillow's CEO and co-founder, the reason why they stopped their iBuying program, Wells Fargo interviews with Wells Fargo and Morgan Stanley analysts. For those who have missed it, feel free to go back to our previous episode. So on this we're gonna be highlighting the weekly jobs report, Elon Musk dumping some Tesla shares, and the ongoing options activity, Goldman Sachs outlook for the next year, and of course the inflation that's happening everywhere. So for the weekly jobs report or weekly jobless claims that was announced yesterday, we have now dipped to 267,000 jobless claims, setting yet another pandemic low. So this is a good sign for indicating that people are getting back to work.
That's good news.
Good news, bullish news. And on to our next, it's Elon Musk that's selling some of his stock.
What is he
So
going to do with that? All that money.
all that money. So yeah, over the weekend, Elon Musk just posted in Twitter asking all of his followers, which I'm not sure how many he has, probably more than a million.
He said
um,
it's to pay taxes, but I I also heard that he's being challenged to help with world hunger.
right. Oh yeah, I saw that. If I think World Health Organization, if that's the organization that he asked what they would do with the 6 billion, he would sell his 6 billion worth of his stock to fund whatever their project would entail to solve world hunger. But yeah, he asked all of his followers over the weekend whether he should sell his stock, and surprisingly or unsurprisingly, most of his followers answered yes, he should sell. More than 50% answered yes.
Mhm.
So a little that we found out just today that some of the transactions were actually arranged prior to his Twitter poll, which is fine. He owns his shares or whatever it is. Um, so he can do whatever he wants. He just wants consensus, or at least he wants some everybody participating, because in reality he's the largest shareholder. So probably he just doesn't want to have a negative reaction among all of the Tesla investors and stockholders.
Mhm.
So it says here the world's richest person has disposed more than 4.5 million shares so far this week, according to regulatory filings. Those were his first sales in more than 5 years. So a good
Mhm.
amount of selling for this guy. So since he had announced or he had made the poll over the weekend, Tesla stock price has kind of dropped,
Mhm.
erasing about 50 billion,
From
going
his
down,
network.
erasing 50 billion from its net worth, and bringing the stock price decline to at least 13% down. So looks like it's gonna be he's still slowing down, not slowing down. I mean, he's just selling it one portion at a time. It's not like dumping everything all at
Mhm.
once, because that might actually trigger some panic selling, indiscriminate panic selling, if
Yeah.
yeah,
He's
if the liquidity in the market is not enough to capture all that.
Yeah.
Mhm.
He still has a lot of those options left.
Oh yeah,
So he
he has a
still got a
bunch.
lot to sell if he wants to.
Yeah, looks like it says here a regulatory filing from this week said that the billionaire still has 21.6 million exercisable
Ooh.
options remaining for from the 2012 award. Disclosure in past Tesla filings, though, indicate that Musk would have only about 20.7 million contracts remaining after Monday's transaction. So this guy still owns a bunch of options for Tesla. So despite the Tesla stock performance, Kathy Wood, the forever Tesla bull, says here that Tesla's rough week so far this week is only a blip on its way to $3,000 a share stock price. So
And she's
nothing,
very bullish about the company.
yeah, nothing scares the ARK investment management head, Kathy Wood or Kathy Bay, before anything else.
Mhm. They
So
have a strong conviction on Tesla.
definitely strong conviction. 3,000 from $1,000 a share. It's like 300% increase or triple from today's
Mhm.
stock price. So that's a good amount of jump from here on out. So that quite Tesla's market reaction and recent announcements made me wonder what its valuation at this point in time. So I took a look at its valuation according to Seeking Alpha. So we have here price to earnings. We're gonna look at forward gap ratio. So this is its current stock price over the next 12 months earnings. So right now it's trading at 244 times earnings
Mhm.
compared to its median, or at least 50% of its compadres, 18% or 18 times. So that's quite a big difference. Price to book 39 times, almost 40, compared to its fellow car makers or GM or Ford. Their median is around 3%, 3 times, 3.3 times. So
Mhm.
definitely trading above everyone else. So
Yes.
what's interesting is there's this newcomer that just listed their stock price yesterday, and the company's name is Rivian. So this company is, I think they initially wanted to list around 78 bucks a share, but
Yes.
it jumped over 100 at one point in time. So this is an article from Bloomberg yesterday after post IPO said entitled Rivian Market Value Leapfrogs Established Car Makers on First Day. So
Unbelievable.
it's pretty
Mhm.
self-explanatory right there. And here's a
Mhm.
very helpful chart provided by Bloomberg. So, road to the top, it said Rivian's debut places it among the world's most valuable automobile stocks. So, of course, Tesla, $1 trillion valuation, followed by Toyota at 290 billion or 289, about $700 billion less, and then Volkswagen, BYD, General Motors, and then Rivian. Rivian currently at 86 or $85.9 billion. So it's well more valuable than Ford and some other companies in China like Great Wall, Lucid, and Neo. Is Lucid in
Mhm.
China? I'm not familiar with Lucid.
I think Lucid is here, right?
Oh, here
Lucid
in
Motors
US,
is here in the US.
right?
Yeah,
But
Rivian is up like 122 today, went up again
wow,
another 22% today.
22% in one day. That's crazy. That's a lot. Uh,
Mhm.
So yeah, so upon enlisting, so Tesla's founder, of course, Elon Musk, gave his thoughts on Rivian. So the tweet went by when Tesla IPO'd at a value of 1.7 billion, they had been selling Roadster for 2 years, and had stunned the world with Model S reveal the year before. No criticism of Rivian, but 24 hours into IPO, market capitalization is $100 billion with nothing, with zero revenue. A sign of the times at Elon Musk. So Elon Musk replied, I hope they're able, or Rivian, able to achieve high production and break even cash flow. That is a true test. There have been hundreds of automotive startups, both electric and combustion, but Tesla is the only American car maker to reach high volume production and positive cash flow in the past 100 years. So definitely a hit
Yeah.
there to Rivian from Tesla's Elon Musk. So it's about cash flow. Tesla definitely is making some cash flow at this point in time. Even before
Mhm.
they're able to generate any cash from their models or products, they were actually able to generate a little bit or some of it from carbon emission credits. They're selling carbon emission credits to big car companies to offset their carbon monoxide or pollution or whatever to not
Mhm.
to not get entangled with the government's penalties and such to
Mhm.
offset their production. Yeah. So yeah, jumping on to our next slide. So this is what we were referring to earlier, options activity. So at this point in time, this is a chart provided by Goldman Sachs. This was just published, I think, within 24 hours. They've identified that as of this month, November 11, options trading has been 50% higher than shares volume months to date. So what does this mean? It basically means that options activity in the stock market is now a lot greater than the shares or share share trading or stock trading. Excuse me.
Yeah, they've been predicting that the options market will grow this year and probably grow more next year
Yep. I
because
think
of retail investing.
yeah, it's giving everybody a strong um incentive to trade the market and generating generous returns if you're right on those trades. But
Mhm.
yeah, as you can see here, it never really did hit any 50% or more back in 2019 and 2020, but it started hitting that level back in August of last year, and starting
Mhm.
April of this year, it just pierced through that marker, the
Mhm.
option volume as a percentage of shares volume, and now it's been like 50% higher than the shares. So definitely a lot of option trading out there happening. So another chart from Goldman Sachs, single stock option volume is concentrated in a few stock slash sectors. One stock obviously is Tesla. So Tesla's option volume has been 75% of the total ETF option market. So that's huge in terms of daily option volume. So you can see here in Tesla alone, it's averaging at least $241 billion of option
Mhm.
trading per day. And it's followed by Amazon at $138 billion per day. And all the rest per sector, technology and media. Technology plus media and entertainment at 220 billion. And all other stocks, $112 billion a day. All ETFs, including SPY, of course, it is a huge amount.
Mhm.
They generate 323. But yeah, Tesla is definitely a standout. Not only its market capitalization, not only for its CEO, not only for its founder, but also in the
Mhm.
options market.
Always been a volatile stock with a volatile CEO.
Mhm. And you would think, like at a $1 trillion valuation, for it to be moving up and down so much. And now, as I've shared earlier this week on our group, that Tesla is actually the fourth largest component of the S&P 500.
Mhm.
So I would imagine it would at least stabilize at some point of time, find a price stabilization. But it's been going up and down like a penny stock, looks like,
Mhm.
and regardless of its size. So one true but one true reason could be this is the reason why the huge option that's happening in its stock, or not stock,
Mhm.
actually options. So back on a previous chart, it makes sense now, because if options is driving the market, Tesla being the largest concentrated options play out there, so definitely, Tesla is still volatile, like you said, Huawei. So
Mhm.
it's something to watch out for. Wonder if whether retail investors will get tired of it, or eventually it will find a price stabilization at some point and be a little less volatile, like the Googles and Amazons of the world, or Apple at a $1 trillion valuation. Well, Apple
Mhm.
is 2 trillion. or so. So yeah. Okay, on our next slide, it says this is a Bloomberg opinion article entitled Goldman Sachs Top Trades Reveal Uncomfortable Truth. So the Wall Street Bank's calls for the year ahead implicitly acknowledge that the headwinds for the US stock market are becoming much stiffer. So this was published yesterday. So it looks like we have a sort of like underperforming outlook, which I could surmise from the title alone. Um, let's see. It says here the fact that Goldman doesn't have another year of outsized gains for the S&P 500 as one of its top ideas is concerning, and not just because of stock valuations at near the highest on record based on price to earning ratios and other metrics. The lack of conviction is probably most notable because the firm was one of the more bullish on stocks entering 2021. So with a year-end forecast of 4,300 for the S&P 500. So it's S&P is now around 4,660. So it's 360 points above its target.
So what changed their conviction?
Mm,
The overvaluation of a lot of these large companies.
Well, it says here their valuation still sticks, and actually they still see 4,900 for S&P
Oh,
500 for its 2022 forecast, which is among the highest in Wall Street. But their call implicitly acknowledges that the headwinds for the stock market are becoming stiffer. So these are just assumptions. Perhaps single biggest factor behind the run up in stocks both in the US and globally have been government and central bank largesse, and both are coming to an end. So the tapering, of course, with the money supply no longer growing, the question becomes what else is there to keep valuations at their current lofty levels?
so it looks like,
So,
most investors should start looking at actual financial statements and focus on earnings. It's been a popularity contest this past few years, looks like.
yeah. So what Goldman says here as their recommendation is the best Goldman can muster when it looks at the equities markets, stock markets, is to recommend investors to have exposure to Mexican and Russian shares in US dollars, as well as going long Egyptian shares.
Oh, interesting.
So look
First time I
overseas.
heard of that. Yeah. I better write that down.
Mhm.
All I know, the South American airports are doing better since the reopening,
More travel, yeah,
more
more people
travel.
vacationing.
So the first signs were airport activity has increased and
Mhm.
airport earnings have increased for South America.
Right. For Mexico, I think they have this company called Mercado Libre, which is like their Amazon. So
Oh
that's
yeah,
something to keep an eye on. Yeah. Or an
yeah.
eBay. I think they have eBay too.
Ticker for that would be MELI.
Mhm. Mercado Libre. Okay. On our next slide, on Bloomberg, entitled Most Expensive Gasoline in America Close to Record Highs. Californians may
Oh
be
wow,
in for sticker shock at the pump this Thanksgiving. So
it went up higher.
gasoline, California's gasoline prices are only 2 cents away from hitting an all-time high. So not just the stock market, as fuel prices have soared nationwide just 2 weeks ahead of the Thanksgiving. California retail prices averaging $4.65 per gallon, 2 cents away from hitting the record high in 2012. Ooh. Californians typically pay for more gasoline than anywhere else in the US. Nationally, prices at the pump are at averaging $3.42 per gallon, the highest in 7 years.
I've been hearing that they're increasing their drilling activities here in
Mm-hmm.
Texas, both on the Permian Basin and in the area um, along the eastern side of the state.
Mm-hmm. The rig counts are climbing.
So yep, the rig counts are going up again, and so they're, some forecasters are predicting an oversupply next
Mhm.
year,
Oh,
which
that.
they said will bring
Mhm.
prices down. But that's a prediction.
Mhm.
So it all depends on how much activities in the drilling side of things
Right.
on
It's
the upstream.
yeah, it's boom and bust in terms of oil, energy and oil for sure. So here's another article concerning inflation. Inflation is hurting 80% of British businesses, survey says. So this is not only exclusive to the United States, also in British chambers of commerce. Um, so this is a lobby group that surveyed at least 1,000 companies over there in Europe. So it says here a quote from Siobhan Haviland, Director General of the BCC, quote unquote, these figures present a deeply worrying picture of the difficulties that businesses are currently facing. Steel costs were cited by half of manufacturers, while paper, plastics, chemicals, and semiconductors also registered as in short supply. So it's not just the consumers that are hurting with inflation, it's also the businesses that requires raw materials to produce their products. And what's a little bit concerning here is, as we have discussed last week, that consumers have started dipping into their savings, bringing this overall savings rate lower, back to pre-pandemic levels. Is the thought that wage increases would actually offset the inflation increase. But according to this article by CNBC published yesterday, is entitled "Inflation Has Taken Away All the Wage Gains for Workers and Then Some." So real average hourly earnings, when accounting for inflation, actually decreased 0.5% for the month. A 0.9% inflation increase negated a 0.4% rise in wages. So, these are a lot of percentages. So, in summary, it's just inflation has increased more than wage increase. In addition to that, consumer confidence, as we have also pointed out, this isn't the first time that we've seen the decline. We've been we've been looking at consumer confidence decline since mid last month, when the appetite for buying used cars have declined. So this is something to keep an eye on, as consumer powers the U.S. economy. So if consumers stop spending or stop buying, stop taking debt, stop using their credit cards, then slowdown is inevitable. So that's something to
Yeah.
keep an eye on. And
Yeah, the
mhm.
University of Michigan report should come out tomorrow, Friday,
Oh, good, good.
for
Yes.
us to look at. And just thinking about it, it's predictably gonna be lower. But I've also been listening to Bloomberg News, and
Hmm.
it looks like um, one of the interviewees there was saying that she's seeing that there is actually an uptick on consumer buying
Hmm.
uh, um, for the holiday season. So she's saying that it seems like the consumers are ready, you know, to shell out some of their savings for the
Right,
holidays. So
right.
that's a good, a, you know, good news for the time being. But data will show us later if this is gonna be a going trend or just a short blip
Hmm.
in the market sentiment.
Right. And definitely there's some data to watch out for, because that's what everybody's looking at in terms of consumer behavior. So this is a chart for those who are watching in YouTube. You'll be able to see here the tracking of consumer price index and average hourly earnings. So you can
Mhm.
see here actually the CPI, or the one that kind of tracks, sort of
Inflation.
reflects the inflation. Yeah, has turned higher compared to average hourly earnings. So that definitely defeats the purpose if employers or businesses can only raise wages at a certain amount while inflation keeps surging. So that's quite troublesome picture right there. But regardless, so this is another graph that we saw from Bloomberg from Bureau of Labor Statistics. Annual price increases all over the place, from housing to meat, poultry. Annual price increase have ranged from 2.5 to 12%. And what's also contributing to this significant changes or increases is the never-ending container ships being stuck there at the ports. So this is a Business Insider article published yesterday entitled "A Record 111 Container Ships Are Floating Off California's Busiest Ports Despite Biden's 24/7 Schedule and Looming Fines." So there are a bunch of containers out there. Number of container ships stuck off the ports of LA hit a new record on
I think
Tuesday.
they were able to take a lot of the empty containers out because of the pending fines. They said that 22% of those empty containers have been hauled out this week. So there's a little bit of sign of easing over there.
Well, that will be important because this is a quote from Corey Birch, Vice President Solutions Consulting at Slank.io, a global logistics company. Quote unquote, "The issue isn't about a lack of desire to move boxes, but a lack of physical space." So the fines that the Biden administration will put to these companies will simply, quote unquote, simply get passed onto beneficial cargo owners who will begrudgingly accept that their rates have gone up. These containers would move if they could, but it's a combination of warehouses, truck, and labor issues. So the fines, this thing is a little bit concerning though. So we're already experiencing a lot of inflation in some of the products. Well, not some, but everything, as we're gonna see in this series of screenshots. So fines would be passed on to these operators, and their rates will definitely go up to counter or to get into break even or get some profits to pay their employees and to expand their business. But as a result, I'm thinking they'll pass it to the sellers, and the sellers would eventually increase their prices, further increasing the inflation. So at what point will this be? We won't know when will exactly be at least in an equilibrium, which usually it's not. Usually we experience inflation every year. So this is just I would say definitely an anomaly. Well, the Fed is saying it's transitory, so I don't know
Yeah,
how
that is
that's things
becoming
go.
more and more questionable now because once prices have been adjusted up, it's usually harder to bring that down.
Exactly. Yeah.
So they're hauling a lot of those containers. These cargo ships have been, and I mean, companies have been hiring some smaller ships to haul out the empty containers. And like you said, that's gonna cost something.
Yeah. Expenses, costs will be passed on to the consumers in the end. So here's an interesting article. This is also our title. Thanks to Forbes, they published this article: "Meatflation worsens as prices rise at fastest rate in 30 years" in October. So last month we just experienced the fastest rise or inflation in the last 30 years, three decades. Amid a higher than expected 6.2% increase in CPI, the price of meat, poultry, fish, and eggs rose 11.9%, the fastest increase since December 1990, Bureau of Labor Statistics said Wednesday, with beef prices up 20%, pork up 14%, adding to concerns that inflation will stick around longer than expected. That answers our question, transitory. So looks like it's gonna be here for a little bit, gonna affect our buying power for sure. So these are screenshots I took yesterday from Fox. Recent price spikes. We'll just go through it. Apples are now up 7.8% from last year. Eggs up nearly 13%. Soda up 5%. Ribs, spare ribs, no, it's ribs, 19%. Ham 7.7%. Cupcakes 5.5%. Sausages 8%. Bacon 19%. You can see definitely that meats are climbing up. Steak 22%. Fish nearly 11%. Obviously, oil is way up there, 36%. Gasoline, 42. Furniture, almost 14. Car rental is still high, 43%. Cruise, 11%. Despite that, here's a wonderful uh, article from Financial Times that was just published also the same day. Well, a day before they announced those findings, a couple of days before, entitled "Wall Street Equities Complete Longest Run of Closing
Yes.
Highs Since
Mhm.
1997."
It's amazing.
Blue chip S&P 500 index is up more than 25% since the start of the year.
Mhm.
So it's an incredible record that we have set this year. The S&P 500 has now closed at a record high 65 times this year, the second
Mhm.
highest total in history. It has risen more than 25% since the start of the year, more than doubled since the coronavirus induced market rout of last year in March.
Mhm.
It's an incredible
And
feat.
yeah, and with it comes inflation.
With it comes inflation. And I've seen some analysts actually talked about it, which we're gonna play in a little bit. Some of them are actually saying that inflation is good for stocks, but the problem is how good it would be if it's really way up there, which nobody can really, you know, project or forecast. So one thing the administration is doing is they're gonna try to pass the 1.75 trillion spending bill, as Biden had said. I have directed. Hold on. Yeah, U.S. President Joe Biden on Wednesday singled out rising energy costs as primary driver of inflation, and said it was top priority to reverse the continuing trend. So, quote unquote, I have directed my National Economic Council to pursue means to try to further reduce these costs and have the FTC, Federal Trade Commission, to strike back at any market manipulation or price gouging in the energy sector. He also implored Congress to pass his 1.75 trillion spending bill, saying, quote unquote, 17 Nobel Prize winners in economics have said that my plan will ease inflationary pressures.
Mhm.
So I guess hopefully, well, we will find solutions not just by passing the spending bill, because another round of stimulus or not stimulus, this is spending bill, could actually indirectly cost some more money supply, fewer products getting stuck in the ports, more inflation. But this is a chart that I just saw from Charles Schwab report. It is entitled "Inflation is on the Rise, but still pales in comparison to the late 1970s." So 1970s, we saw a good amount of spike of inflation above 10%. So, and in 1980s, we actually reached 15%. So it it may not be it may not be evident in all products that prices are increasing, but definitely we feel it in the grocery section, the meat section, and also in our energy, oil, for sure. So some budget adjusting,
Well,
priorities.
we'll definitely have long-term repercussions from the government's uh, actions
Mhm.
to address the COVID pandemic. So um, we just don't know. But what we know is taxes will definitely be changing. Um, some of the tax rules will expire by 2025, and there are already proposals to tax corporate at 15%. Um,
Mhm.
so we're gonna see changes for sure,
Right.
because with all this money in the market Somebody has to balance that out somehow, and
Right.
that would be in the future run.
Yeah.
But what I'm seeing here is if we increase productivity and correct the supply issue,
Mm,
then we could ease off some of the inflation pressures. Um, but prices will be up, that's for sure.
mhm.
I don't think it'll go down. That's just my opinion.
Right.
Um, Based on historical perspective,
Mhm.
from what we see in the past, prices will remain high uh, in relation to what it was a couple of years ago.
Oh yeah, for sure. Before the pandemic. So yeah. So going back to the U.S. because earlier we had what do you call it? A survey among British companies, 1,000 of them. So they're feeling the pinch from inflation. And now we have an article from MarketWatch entitled "U.S. Small Businesses Sentiment Fell Slightly in October." So optimism among small businesses waned slightly as short-term economic expectations worsened. So quote unquote here from chief economist of NFIB, Bill Dunkelberg, quote unquote, small business owners are attempting to take advantage of current economic growth but remain pessimistic about business conditions in the near future. So let's find a specific reason why. Owners have grown pessimistic about future economic conditions as this indicator had declined 17 points over the past 3 months to its lowest reading since November 2012. One of the biggest problems, here we go. One of the biggest problems for small business is the lack of workers for unfilled
Mm,
positions and inventory shortages, which will continue to be a problem during the holiday season. Whew. Yes, sir. Christmas is around the
mhm,
corner.
mhm. So, what
Supply
does it take
chain,
to get people back to work?
more
Um,
wage increase.
Wage increase, benefits, more more flexible scheduling.
Mm. The thing about the wage increase, though, at some point, if you give, well, it's kind of cycle. It should balance out eventually. But if you give more wage increase, which currently is not enough, as we have all just discussed. So according
Mhm,
to that CNBC article earlier, we are actually negative 0.5, 0.4% in terms of inflation versus wage increases.
mhm,
What I'm trying to get into is if you gave too much wage increases, then that will then enhance the buying power and then more demand and then fewer supply. If the supply chain is not fixed by the time or at least alleviated, then it's gonna be further on out that we're gonna experience inflation, which is a little bit concerning. So around 39% of respondents said that the supply related bottlenecks, as we've been discussing, have significant impact on their businesses. Another 29% said moderate impact, 21% mild impact, 10% no impact. So maybe the 10% are like working on software and stuff. Maybe they don't need any supply or any products as much, just software. So jumping on before to our weekly sentiment surveys, and oh, my dog is back. Sorry about that. So before we jump onto our weekly sentiment and flows, we have a brief article here or update from MBA, Mortgage Bankers Association, that we also track for the property market, U.S. property market, published yesterday. It's entitled "Mortgage Delinquencies Decrease in the Third Quarter of 2021." So this is a good sign for the property sector. The delinquency rate for mortgage loans 1 to 4 unit residential properties decreased to a seasonally adjusted 4.88% of all loans outstanding in the third quarter of 2021.
That's
So,
good. That's good
yeah,
news.
it's good news. It's very supportive of our ongoing red hot real estate market. So, according to Marina Walsh, MBA's vice president of industry analysis, quote unquote, for the fifth consecutive quarter, mortgage delinquency rate has declined, commensurate with a decline in the US unemployment rate over the same time period. Improvement was driven entirely by decline in later stage delinquent loans, those loans that are 90 days or past due, but not in foreclosure. By the end of the third quarter, many borrowers were approaching the 18-month expiration point of their forbearance terms and were being placed in permanent home retention solution, such as modifications and loan deferrals. Once these borrowers entered permanent post-forbearance workouts and resumed payments, they move from delinquent to current status. So the government still has modifications and loan deferrals. So they don't just drop them like a hot potato and have them put on forbearance or delinquency status. They still have assistance from the lenders.
That's good.
So which is a good sign. Yeah, they're
They're
very supportive.
refinancing.
Mhm.
Refinancing.
Yep. So mortgage delinquency in this chart definitely trending down since 2010. Well, I don't see 2021. Maybe I could open it to a new page. Let's see. Okay, here we go. So on this chart, definitely a sharp spike during the lockdown, reaching all-time highs in terms of delinquency rates back last year, above almost 14%. But now we're at all loans total past due is down to 4.88%, like the article said. So that's good news for property segments. So now we're gonna go into our weekly.
Yeah. And mortgage rates are
sentiments.
still at their lowest low.
Oh yeah, it's still around 3%. So it's still a good time to buy. I mean, we're not pushing it to buy, but in terms of the interest payments,
Mhm.
mortgage interest, it could still be lower. You could still be able to afford to buy a more expensive house with lower payments because of the lower interest. So
And if
here's
people
the
haven't refinanced, this is a good time to refinance.
Mhm. Taking into account the cost, because sometimes I think costs could spike up. So you might want to consider how long will it take you, how much will it save you. If interest payment, a monthly payment, mortgage payment would under refinancement could save you $200 a month,
Mhm.
but the cost upon closing of your refinancing would be around somewhere $2,000. Then just make sure you'll be in the same house for at least 10 months or more than that to
Yes. Mhm.
justify the costs, the closing costs, because there are hidden, not hidden costs, but costs associated with refinancing. So our
Exactly.
sentiments, we have the American Association of Individual Investors. So this was published so a day early, Wednesday, yesterday. Bullish sentiment,
Getting stronger.
48%. Yeah, getting stronger. 7.5. Yeah, 7.5 higher. 7.5% higher than last week's. So we're definitely there in a bull market sentiment. Bearishness has died down from 26 to 24. So we're at 48% bullish compared to historical average of 38%. So we're 10% percentage points higher than the historical average. Fear and greed index, we're at extreme greed, 81 points compared to 82 points last week. So if you're going to look at the chart, a little bit of dip, 1 point dip, but we're still trending at really high markers right now. So something to keep an eye on. Volatility index for the past 5 days. Actually, the
Mhm.
market has been going down for the past 5 days. So volatility is up 16%. So it's the volatility index is still within trading its average, like 15 to 25, I would say maybe 30 even, including last year's performance. So that results, the volatility within the past 5 days resulted into the S&P or all of the indices down for the past 5 days as well. So S&P is down 1.3%, Dow Jones down 1.4%, NASDAQ is the more or less being hit harder because of its tech background and the
Mhm.
threat of inflation. Put call ratio, options market definitely driving what's happening on the overall stock market. So we've started tracking this. So it's still down,
Mhm.
Options traders are still bullish. Calls, they've been buying more calls than puts. So for this past week alone, basic materials is the top performer, 3.37%, followed by industrials, not so much, 0.82% up. The worst performer, interestingly, is healthcare, negative 2%, which we're going to hear in a little bit, our next slide, with an interview. And if, yeah, in previous episodes that we have had, while we, I think, Morgan Stanley has been pushing for healthcare, diversification to healthcare as a good exposure as now we enter inflationary environment. But for the past year, obviously, energy is the number one, 57.9%. Everybody else is on the green. Bitcoin, we're at 74 points or green compared to last week's 73 points. So not much difference. So now we're going to our weekly roll the clip segment. We have a couple of interviews. First one is from Bloomberg, entitled Inflation is Running Hot, What It Means for Stocks. This was published yesterday, almost 7,000 views. Let's roll the clip.
So at some point, interest rates rise. That's going to knock out all this value, the valuations that we've seen. To that point, I should point out that Rivian is indicated on open 125. So talk about valuations. What do you think?
Alex and Guy, thank you for having me on the show. Of course, this market has given us a surprise after surprise after surprise, and valuations absolutely matter. And as much as the retail investors in the markets tend to ignore the issues that we're seeing, such as higher material costs, supply chain interruptions, higher labor costs, all of that eventually is going to translate into the earnings revisions, not to mention potential for higher taxes, higher inflation. This is the reality. And with that said, we see the consumer strongly supporting this market, and we think that this spending, strong consumer spending, is going to continue throughout the end of the holiday season. But the question is, what comes after? And as much as the retail investor is so worried about taking money off the table too soon, in our opinion, what they should be worried about is the excessive risk to their portfolios. And this is the perfect time to gravitate towards defensive plays, to take profit, and to be in the sectors that are strategically positioned towards this more volatile market that presents a lot of challenges.
Alex is going to chuckle and laugh at me now because I've been asking this question a lot, but I hear it a lot being asked by other people. Are you suggesting that you should not be fully invested at this point?
Guy, absolutely. This is precisely what we're suggesting, but not to be fully invested. We are suggesting that we shouldn't be invested in exactly the same sectors that are disproportionately up. And this is the perfect time to evaluate our investment portfolios, see what sectors performed well, take some gains off the table in sectors like S&P 500, like Russell 2000, like certain parts of technology, and pivot to sectors that are positioned to do well in the following years, like healthcare, for example, where there's a lot of pent-up demand due to COVID. We're going to see this for years. Like financials that are positively correlated to the higher interest rate environment. I mean, this is going to be a reality. Fed is about to start raising rates. We really like consumer staples. We're a little apprehensive about consumer goods, but we still like consumer services. So the point is, there's still a way to make money in this market. It's okay to be fully invested, but we should be doing it in a very smart, strategic way.
Guy, I knew you were going to ask that question next. I think the mind meld today is complete. So, Katerina, Citi had an interesting call out the other day, saying that they're actually positioning for a decline in inflation. Like they see the peak coming, say, in the next 3 to 6 months, and they want to position for a decline in inflation. Does your thesis encapsulate that, or does it wrap in higher, more sustained inflation?
Alex, it's an interesting time when it comes to inflation. Federal Reserve, for example, views it as perhaps transitory in nature. But in our opinion, we should consider the fact that higher inflation is perhaps here to stay, both higher inflation and higher taxes. What we see right now is the increase in costs supported by higher demand. But we can't ignore the fact that it is also fueled by stimulus checks, by the fact that people had more money to spend because of the performance in the market and in the cryptocurrency. And going into the new year, is this trend going to continue? To come back to inflation, we actually think that inflation levels are going to be higher, and perhaps they're here to stay.
Do you think wages keep up with inflation? Your comment on the consumer being fairly healthy at the moment, it's certainly borne out by the data, but there is a gap currently between wages and inflation. There is a squeeze on the consumer.
Yep.
Does that get does that become a bigger problem next year? And if so, how does that work its way back into the market?
Yeah, it certainly is a data to watch, and the labor market is really challenging right now. We are on one side are seeing labor shortages and then pressures on wages, but what we are also concerned about is the decreased saving rates in this country. And we always say in almost every narrative that consumers are driving force behind our economy. As we're seeing this rate of savings declining, this is something that could present a challenge, absolutely.
I just want to point out we're getting another read now, and Rivian indicated to open at 120. So it really does feel like we're bouncing around this 120, 125 level. Remember, that stock priced at around $78 a share. Katerina, where does this leave your view on technology stocks, like the big tech names, where if you haven't owned them, you've just gotten really beaten up and you can't seem to beat your benchmark, really? What do you do?
Alex, we're not ready to give up on technology yet. The most exciting part about the world of technology is research and innovation and how much investment is being made into this technological development. So we think that this is the time to be really selective about the technology plays. And technology absolutely should remain within the investment portfolios, but competitive positioning of select technology companies or sectors that we have in our portfolios are more important than ever. We have to evaluate the portfolios. And again, we're huge proponents of profit taking. This is the time where if you see the disproportional growth in certain sectors of technology, in our portfolios, this is the time to not abandon that sector, but to strategically take profit and reallocate to the parts of technology, that sector that are going to continue to grow. And there's tremendous amount of opportunity there. And we think money is absolutely to be made in technology.
Where does that leave the headline index? I heard what you said about the S&P. I heard what you said about the Russell. As we get this rotation, does the index level come down?
Guy, there is a time for investing in indexes, and then there is a time where the active management and very careful security selection takes place. And this is the time for quality. This is the time for de-risking and strategic positioning. So when we look at the positioning of this sectors within the portfolio, we have to ask ourselves, is there a competitive advantage? Is there a the price sensitivity, right? That these companies can take advantage of, or is it something that is disproportionately positions them to not make a lot of profit next year? This is the time for all these questions. So we believe that this is not ideal time for index investing, but instead rotation to quality and individual security selection, would work much better in this market.
Wow. So this is not the time for index investing, but allocating to specific quality companies, and de-risking from your winners or to more quality. Oh.
Yeah, and I'm, based on what we just heard, I was also thinking about what Motley Fool has been recommending recently, to look into your portfolio and save 10% of your cash. 10% into cash.
Like de-risk.
To de-risk. Exactly. So, rotating some of your stocks to what she said, like healthcare
Mm-hmm.
and
Financials, healthcare,
and fine.
financials.
Mhm.
And she said that they're not giving up with their technology, but they're moving out of their probably more riskier investments. Maybe
And
Tesla. I don't know.
yeah, that would be growth stocks. Yeah, yeah,
Yeah.
absolutely. So I've been thinking about doing the same thing. I've sold some of my Tesla shares last month, and I'm again looking at selling some of them
Mhm.
to increase my cash holdings, because of the potential repercussions and changes for next year, and that would allow you some ability to get some bargain,
Right.
buy some bargain. Uh,
It's always
well,
good to have a buying power or dry powder on the side just in case something goes haywire
exactly,
and you'll be ready to jump in.
and that's on top of your emergency savings.
Mm-hmm. Yes. All right. So
Yeah.
we're gonna go into our last interview for today. This is a CNBC interview published 3 days ago. 23,000 views, quote unquote. There's a rotation being made in the markets. SoFi's Liz Young. Let's play.
I do want to highlight the market itself and get to Liz Young, because we have been up for 5 straight weeks.
Okay.
And we're waning just a little bit in where we opened to where we look now. The S&P, as I last saw, dip negative a touch there. It's basically on the flat line. The Dow right there is hanging on by 47. There's the NASDAQ, which has had this incredible run, 10 days up in a row, going for 11 today. Small caps, we know about those too. I mean, they've been at record levels, and the Russell 2000 is up by more than 13. So Liz Young, I've got this new price target now from Piper Sandler. They say stocks are firing on all cylinders. They start to look into next year, and they put their first price target on for next year for the S&P. They go 51.50. It's about 9.5% to the upside from now. Just give us your view of where you think we are now, because there was a time not that long ago you were a little cautious, and I think you came around and said, well, maybe the environment's actually changing and going to lead us into next year pretty strongly. What do you say?
Well, so first of all, even 9.5% up from here, let's say we get another 2% this year, that's 7.5% next year. That's a pretty normal environment for stocks, which would be semi-disappointing compared to what we've seen, double digits up over the last couple of years. So I think investors would look at that as a tiny disappointment. But I do think that there's a tailwind into year end. And you're right, I did come around. I also think if you just listen to everything that the other traders have said already at the top of the show, obviously there's a rotation going on. I don't think there's anything more indicative of a rotation than what we heard about all of these moves that were made. Maybe some of us think the rotation is in different places, but there's definitely something going on under the surface. There's a lot of repositioning happening. Also, I think investors need to keep in mind there's been a momentum shift, and I think Joe would agree with me here. Don't fight momentum in the short term. There's been a momentum shift from about August, September until now. So in August, September, momentum in growth had slowed down, economic momentum had slowed down. Now we're heading into the end of the year. We had a Fed statement that didn't freak all of us out. We have a 10-year that didn't go off the charts. And we've got the Santa Claus rally, the seasonal period that should be strong for consumers. And we should make it through the end of the year with fewer bumps than I think all of us expected maybe halfway through the year.
I'm guessing, Joe, your counter to that would be, look, I'd rather be early than late. That, I'm stepping out of the way, even if I think momentum can continue. Remember, we're in the period of the year where the next 3 months are traditionally the best. So you've got seasonals are on your side too. To continue momentum, you're willing to miss out rather than wait too long?
Yeah, I think that's fair, but I agree with Liz's points that I think there is a dramatic shift currently unfolding in the market. You mentioned before the Russell making an all-time high. Well, it just did that in the last several days for the better part of the last 6 months, going sideways. So we're seeing this dramatic change, Scott, where finally there appears to be this broadening out of the potential for there to be a revival in economic growth after a period where we slow down. And I think what's important too is that the earnings season really began on October 13th. You've got the S&P up about 7.5% since then. And I think that's the story underneath the market. is that the expectation was because of the pressures from rising input costs and wage pressures, you'd see margin compression. There were estimates for 100 basis points of contraction for profit margins. Well, profit margins have actually expanded by another 75 basis points to an all-time record high. So I think this is really about a broadening out. And a lot of the places where potentially you could say I was hiding in a lot of the growth stories, I just see those as maybe becoming somewhat exhausted. And it's time to think about unlocking some alpha in some areas of the market that hadn't been performing for the last 3 to 6 months.
Unlocking some alpha.
It's gonna be hard to find unless you're looking at agriculture.
Everything else is up, so it's gonna be hard to tackle or to find that next alpha. For me, I'll still stick with my top picks.
Yeah, what
Google,
would
Apple,
those? Oh, okay, the big guys.
the big guys, big tech, nothing
Mhm.
else. Facebook, although Facebook kind of dropped in recent days, but I think they've been performing okay since they changed their name.
Yeah, well, that's a big change, you know. It's not just a name change.
Mhm.
You know, it's a whole ecosystem that they're trying to build there.
Yeah, $10
And
billion for this year budget for that venture.
that
And then
metaverse venture.
yeah, they're called Meta platforms right now, I think, right? From Facebook.
Mhm.
So I guess they'll
So,
receive less heat from the government now. It's weirder to call him, oh, Mark Zuckerberg's Meta platforms.
well, I don't know, but I see it, you know, because they have a captured market already that will probably use their, uh, you know, so I'm thinking about, you know, this ecosystem where they're, you know, trading, they, you know, they got their businesses in there,
Mhm.
you know.
Yep.
Yeah, it's the potentials are there, is what I'm saying. You know, for
Yes.
marketing, it's a huge marketing potential for Facebook.
Mhm. And I think
And
I saw sometime last week that Nike is actually filed for IPOs, not IPOs, but what do you call those trademarks? So as for them for digitally they can still claim that that's their logo and
mhm,
people still have to pay for the rights to use their check mark or the swoosh. So
yeah,
that's
in the crypto world, that's called a token, a non-fungible token.
NFT. Hmm.
Mhm.
Oh well, I think that does it for this week's episode. Wally, before we close it out, I will any quote for our listeners, quote for the week.
Not really. I don't have any code for the week, but you know, just blessings from the land. Um,
Mhm.
so we all talk about money and stock market here.
Mhm.
Don't forget, you know, that some things are free. You plant a seed, you know, a
Mhm.
vegetable, a fruit, a tree comes from the land. It'll
Right.
provide for you and your family
Mhm.
in the future. You know, some things grow like that. Okay, not just the stock market. You know, things still grow from the soil.
Right.
Having said that, I'm just gonna throw this out here, you know, for
Mhm.
people to ponder, our viewers and listeners to ponder. You know, I just read from AgWeb that, you know, China, to feed their country, owns about 192,000 acres in US land at
Mhm.
this time. So we just have to take care of, you know, uh, our land as well,
Right.
and make sure that we um, prepare for the future. You know, take care of the land.
Always
I'm just gonna,
prepare. Mhm.
so I'm not gonna give a quote, but I'm gonna give a story. So many years ago, I have an old man here, a father of a personal friend of mine. He told me a story in World War II in the Philippines. He said, "You know what? You know, Wowie, my family never got hungry during World War II. You've heard stories about people going hungry, dying of hunger during World War II.
Mhm.
But my family flourished. You know how I did that? he said he planted, he planted rice, he grew fruits in the mountains, and he was able to feed both Japanese soldiers and guerrillas at that time.
Wow.
So aside from providing for his family, he was able to provide for the soldiers, both for the Filipino soldiers and both for the Japanese soldiers as well, just to survive. Don't forget that.
Agriculture definitely is a key to survival.
Can be.
Yeah.
And sharing the produce,
Right.
the produce of the land.
That's a enlightening story there, Wowie. Thank you for impromptu story for our listeners. Well, Wowie, I think that does it for this episode of Marky and Wowie Show. Thank you, guys. Thank you, listeners. If you have any questions, just send it over. markywowieshow@gmail.com. And remember, build that emergency savings and invest the rest for an abundant retirement. Again, this is Mark Yu signing
And
out.
Wawi Santos signing out.